Good evening, ladies and gentlemen, and welcome to the latest in Rowley Turton's series of webinars on topics of interest to people in their financial planning. We try to keep these things topical, and today I think it is very topical because most of you, I think, listening today will be buy-to-let landlords, and today is all about that and about some of the challenges which you've been experiencing over recent times and may experience in the future. In a minute, I'm going to hand over to my colleague Scott Gallagher, and he's going to take you through a lot of information about buy-to-let and whether or not it might be time to try something else. Before I do that, a couple of housekeeping things. Your cameras and your microphones will be automatically muted, so that won't be a problem. And if you've got any questions during the webinar, please put them in the question box at the bottom of your screens, and we'll try and answer at the end as many of those as we can. That's it from me. I think other than to say that I'll flag this up now at the end of the seminar today. We'll be asking you if you'd like us to send you a copy of a book which we give to clients. It's very useful and sets out Rowley Turton's approach to long-term financial planning. It's called Enough by Paul Armisen. We'll mention that at the end again, but just to let you know that we'll send that to you if you'd like to next week. We'll also be sending each of you a copy of this webinar with the slides so you can watch it back to your heart's content. Without further ado, let me hand over to Scott Gallagher. He's the director of Rowley Turton, chartered financial planners, and great experience in the buy-to-let area, and he'll be taking you through the options today. Thank you, Scott.
Thank you, Martin. As Martin says, I'm Scott Gallagher, and I'm a chartered financial planner with Rowley Turton. Thank you for joining us this evening for our webinar, Buy-to-Let Landlords, Is It Time to Cash Out? What we're going to be looking at today is a number of factors. Firstly, what I consider was the golden era of buy-to-let. Some debate on that, but I think for the last 25-ish years, I think there was a golden era of buy-to-let investment. Then we're going to look at some of the challenges that people are facing today, or buy-to-let investors are facing: aging landlords, hostile tax regimes, rising interest rates, increased regulation, problem tenants, and possibility or recent experience of falling house prices. And then asking the question, is it time to cash out? And then also looking briefly at alternative investment options and how Rowley Turton can help you. So the golden era for buy-to-let, or as I think about it, by the mid-90s, the UK was arguably ripe for a buy-to-let boom. With relatively depressed prices. House prices fell in about 1988, and by about 1997 they'd only just about got back to the level they were in 1988. So there was about a 9-year period where house prices had gone down and then back up, but effectively hadn't moved. So there's an argument that house prices were due to recover and go up. There was attractive rental yields. I started at Rowley Turton in 1997. And at the time, rental yields were 10, 11, 12%. So you're unheard of today, but were much higher. Rising housing demand, there were some demographic changes, immigration, etc. And therefore, there was more demand for houses. I think younger people were moving out. Certainly, kind of mid-90s, a lot of people I know knew that you had to get on the property ladder. So not necessarily as an investor, though there were people doing that, but certainly the demand for owner-occupiers. So there was a lot of housing demand. Improved mortgage access. Alan Turton, who I work with, previously was a building society manager for Hinckley and Rugby, and he tells me in the 80s of mortgages effectively being rationed, and that wasn't the case in the mid to late 90s. With the extremes later on of Northern Rock's 125% mortgages, I think there were. So there was definitely improved mortgage access, and an increase in short-term tenancies. Rules had changed earlier than that, but essentially long-term secured tenancies effectively had ended, and there was effectively these 6-month short-term tenancies, which made buy-to-let investment a much more attractive proposition for investors and potential landlords than was previously the case. Now it's worth saying that 2023 is not 1997. So I joined Rowley Turton in 1997, and Spice Girls were high in the charts, and it was kind of, I think, a feel-good factor for the country after kind of being in the doldrums for a little bit. I think we enjoyed quite a good period of economic growth. I don't think we're in that situation today. Headlines that Bank of England expected to raise interest rates yet again to 5.5%. Now, it's worth saying that 5.5% by historic terms is not high, but it's a lot higher than it was recent, to say a couple of years ago. And in recent memory, it's proportionately, it's a huge increase, and that has a knock-on effect, not only to investors, but also tenants that, not tenants, owner-occupiers. So I think people are squeezed in that way. I suppose tenants as well, while rising cost of debt, and credit cards, car loans, stuff like that. So it is a factor. So one of the factors that we're seeing is aging landlords. So the buy-to-let pioneers, those people that seen the opportunities in the late 90s and even into the noughties, that became the first real kind of en masse buy-to-let investors, are now becoming seasoned veterans. That's not necessarily a bad thing. But the question is that they're now reaching retirement age or beyond, and they may now have different perspectives and different investment priorities. So rather than building up the wealth, they want to be enjoying it. And they might not want the hassle that does come with a lot of buy-to-let investment ownership. And we've got clients that previously they would manage the properties, they would fix the properties, they would go in and do the basic maintenance to those properties. And when they're in the 40s, 50s, even early 60s, that wasn't such an issue. But now they're in their 70s and 80s, that isn't such an attractive proposition. Of course, you can outsource it, but there's a cost to that. So I think that we're in a different, it's an actual aging of the market, but also those investors and landlords. Next change, and this is change that's been gradual but almost relentless, is what I would consider a hostile tax regime, which has a big impact on buy-to-let investors. We'll run through it briefly. I'll explain some of them in more detail in a moment. So perhaps one of the biggest is the reduction of mortgage interest rate to 20%. So previously, your mortgage interest, not the capital payments, but the mortgage interest payments were offset against your rent, and you're only taxed on the profit. And therefore, it was genuine, for want of a better phrase. Now that calculation is effectively separate. So you're taxed on the rent as income tax with a separate mortgage interest relief calculation of 20%. And what that means is that can push some property investments and property investors from a profit situation to a loss situation on the income, purely because of the change in the tax position. So that's quite a big change that's come in the last few years, and probably didn't affect people too much in the early days when interest rates were lower, so therefore the impact was less. But as interest rates have risen, that's having an increasing impact on people. The next change that came in, or not in any particular order, was 3% stamp duty surcharge. Now, you may think to some extent that doesn't affect you, especially you already own the properties and you bought them before the stamp duty surcharge came in, but it is an impact. If you're thinking of buying new properties, it's an issue. If you are thinking of changing a property, if you want to sell one and buy a new one, that's an issue. And of course, if you're selling a property, even if you're exiting the market and you're selling to another investor, that investor's got to factor that into their equation. So it's going to have an impact into the sale price one way or another. So therefore, it does bear consideration. Another change was that capital gains tax for residential property is either 18% for basic rate taxpayers or 28% for high rate taxpayers. Not quite a simple one, I'll explain that again in a minute, versus 10 or 20% for other assets. So again, that's a situation where property investment is treated worse from a tax perspective versus non-property assets. There was a removal of the 10% wear and tear allowance a number of years ago, which again is not gone down well with professional investors. And then of course you've got 40% inheritance tax. Now that's not a specific change, but I suppose compared to other assets that you can hold, it's not as tax efficient, and it's a tax that a lot of people don't really think about when you're building up your property wealth. But of course, the reality is that when you die, most people with decent property portfolios are going to pay up to 40% tax on those property portfolios. So if you own 5 investment properties worth £200,000 each, you've got 3 children, for sake of argument, 2 of those properties will go to Jeremy Hunt, the Chancellor. I struggle to keep up to date with who the Chancellor is because it changes so often. And the remaining 3 properties will go to your 3 children in that size, so 1 each. So there is an argument that Jeremy Hunt in that scenario is your favourite child. And that's a thing that people, again, don't really think about. But the idea of losing 40% of all your capital and all your hard work is a thing that most people are not happy with, but don't always think about in the way they should. It's worth saying that limited company structures have been used to help to mitigate some of these issues, primarily the removal of or reduction in mortgage interest relief, but it does come with hidden costs, generally additional accountancy fees, and also potentially more expensive buy-to-let mortgages. The buy-to-let mortgage market is not entirely up to speed with corporate structures still, and some lenders don't consider lending to corporate structures. So you effectively have access to a slightly smaller market, and therefore that means on average you'd expect to pay slightly higher for the buy-to-let mortgage. Not in all cases, but it's again a factor. I mentioned mortgage interest relief, the restriction or reduction, as being quite a significant change. And as we see, it's got the potential to turn profits from your rental property into losses. So how does that work? How can a tax change turn a profit into loss? Most people accept that it might reduce your profits because you're paying more tax, but surely it can't create a loss. But it can because of how the calculation works and a separation between a tax on the rent and relief for the mortgage interest. So we've got a fairly simple explanation, but it explains in principle how it works. So you are a high rate taxpayer, so paying 40% income tax. You've got one buy-to-let property, and the mortgage interest, because interest rates have risen, is £10,000 a year, and it generates £12,000 a year in rental income, fees of ignored agents fees and other costs. So it's generating a profit of £2,000 a year, not significant, but of course, most investors will be looking at capital growth on the house as well, so they'll be quite happy with that, or at least reasonably happy. And under the old rules, it was fairly simple. You paid 40% tax on the £2,000 profit, so that's £800, £800 tax bill. So you've got your £2,000 profit, less your £800 tax bill, 40%. So you made £1,200 net profit after you paid the tax man. So not a fortune, but hopefully the capital prices are going up and that's doing well. Now, under the new rules, the calculation is split. So you essentially have a tax liability of 40% of the 12,000 rent, so that's 4,800, with a reduction for the mortgage interest, and that's a 20% reduction. So 20% of the 10,000 is 2,000. So your tax bill, which was £800 a year in the old system, is now 2,800. But hang on, we've only made £2,000 profit, so that can't be right. But unfortunately it is. We're now in a situation where you're making an £800 net loss. So previously you were making £1,200 net of tax profit, and we're hopefully getting capital growth. So the property was generating a net income for you and hopefully delivering capital growth. Now we've got it, we're on an income basis, it's effectively generating a loss. Now some people will be able to sustain that loss, but other people won't, and it's a big change. And obviously that's partly because of tax change, or mainly because of tax change, but also because interest rates have gone up and interest payments have gone up. So that's made the situation worse for people. A capital gains tax. I'll just cover this briefly because, again, people sometimes overlook this. They enjoy owning the property and don't really think about selling it, but it's often that people will eventually want to sell the property or possibly want to, pass it on to somebody else, and that again can have a capital gains tax event associated with it. So for basic rate taxpayers, you pay 18% of any gain. So in simple terms, you're paying 18% of the profit, and for high rate and additional rate taxpayers, it's 28%. But it's worth pointing out that even if you're a basic rate taxpayer, the gains from any property sales are added to your income, and it can effectively push basic rate taxpayers into the 28% higher rate for capital gains tax purposes. So most people, I would say that you're probably expecting a 28% tax. There are some exemptions, if it was your main residence for some time, as lettings exemptions, not always as simple as that, but the simplistic version is. It is worth pointing out that you get an annual exemption, currently £6,000 per person. So if the property is owned jointly, that's £12,000 again that's tax-free. And of course, the buying costs of the property generally taken into account, and the selling costs, estate agents' things and solicitors' fees. But it's quite a significant tax issue. You make £100,000 profit on selling a buy-to-let property, you could easily end up with £28,000 tax bill. So you just need to be aware of that. And finally, the inheritance tax trap. I mentioned before that essentially you can pay up to 40% tax. Generally for a married couple and with children, generally the first £1 million that they leave is tax-free. Transfers to husband and wife are generally exempt, but of course, so it's generally tax on second death. But yeah, people don't think about this. But so if you've got a £2 million estate, husband dies, leaves it all to the wife, wife dies, leaves it all to the children. The first £1 million would generally be tax free. The second £1 million will be subject to 40% inheritance tax or £400,000. So again, if that's 5 investment properties worth £200,000 each with no mortgage, then that's 2 of those investment properties going to the taxman. Rising interest rates is the next factor, which is again a relatively new phenomenon, I suppose. So a lot of investors until recent times would have only experienced low and falling interest rates. You look at this chart, it don't always go down, but there's been a trend for 30 years really, so maybe longer, of interest rates generally coming down. There's 3 reasons that interest rates have generally come down. The first major factor is the expansion of Chinese manufacturing. So in very simple terms, as China in the mid to late 90s really kind of became a manufacturing centre and started producing goods for the West at cheaper and cheaper prices, we saw the cost of goods come down and down. So flat screens, TVs came in and they just got cheaper. They got cheaper and better every year. Mobile phones got cheaper. Lots of things got cheaper. And the impact of that was that the West had lower inflation because cost of goods was generally getting cheaper. And therefore, it didn't need high interest rates to control inflation because inflation was not a problem. So interest rates came down and down. And that's obviously helped house prices while falling interest rates. So that happened for a number of years. Then we had, they were just recovering a bit, but then we had the banking crisis, 2007, 2008. And then typically what happens with a banking crisis, this happened in Japan, happened in Sweden, is that when you have a banking crisis, you then end up with interest rates fall dramatically afterwards as banks try to rebuild their balance sheets by basically paying less interest. There's a number of factors, but that's a factor. And then finally, is again, interest rates might have been starting to recover and certainly talk of it. We had COVID, and again, so interest rates fell yet again because of COVID. And then over the last year and a bit, interest rates have gone up dramatically, especially with the Liz Truss mini budget debacle that we had last year. I think they're losing track of time now. So many changes in government. And there's some arguments about, okay, well, is this a temporary blip? And will we go back to the interest rates that we've seen over the last 5, 10, even 20 years? I suspect not. I think the norm is interest rates of 6, 7%, maybe 5%, somewhere in that band. And I think the last 10 or 15 years is the abnormal period. So I think it's more likely that interest rates stay at that 5, 6%. And that's a factor for investors because that changes a lot of maths. So again, people need to be aware of that, need to consider whether their buy-to-let investment, especially if they're mortgaged, whether those maths still work for them, because I don't think there's a immediate solution. And we're certainly seeing clients exiting the buy-to-let market primarily because of the interest rate increases. And the next change that's happened or happening is increased regulation. I think the rental sector is in the news quite a bit at the moment, and it's in the focus of both the current government and the Labour Party, who may or may not win the next general election. So currently we have the Renters Reform Bill going through. There is some argument that this is effectively stalled and may, because of parliamentary time and the general election that is due not that long away, that this may fall by the wayside. But I don't think that's necessarily a saviour for buy-to-let investors because of what Labour plans to do. So I'll cover what the Renters Reform Bill says, and then we'll look at what Labour said. So essentially, it's the abolishing of no-fault Section 21 evictions. You now need a good reason for evicting people. At the end of the 6 months and you get the property back is going to disappear. A new mandatory ombudsman to deal with, I suppose, complaints and issues. Tenants' right to keep pets. Some landlords don't like tenants to have pets because they're worried about damage and other factors. But again, that's going to be much harder to stop tenants having pets. New rules on rent increases and rent advance. New property portfolio for landlords and tenants. Again, I suspect the cost of that will be borne by landlords rather than tenants. Decent home standards for the private rented sector. I think there's 2 issues with that, really. Firstly is the initial cost of getting homes to comply, certainly older homes, and some talk of homes costing maybe £15,000 to bring up to standard, as you're going to have an impact on things. And then there is, I suppose, a danger of kind of mission creep that it's very easy for the government to revisit this in future years and impose higher and higher standards on landlords, because effectively there's no cost to the government because the cost that will be borne by landlords. And you certainly see that in other areas where there's regulation, that those regulations tend to get gold-plated or improved over time, and that effectively has no cost for the government and cost for the people in that sector. And finally, an outlawing of the blanket ban on benefits. So the old no DSS will effectively go. I mentioned that that was currently stalled and may disappear, but it's worth looking at. We've obviously got a general election that isn't too far away. Currently, Labour are likely to win that if you look at the polling. So what have Labour said? Well, Labour have got their own renters' charter. Lisa Nandy said they will introduce it within 100 days of the general election. And again, well, scraps no fault evictions, so very similar to what the Conservatives are proposing. A 4-month notice period for landlords. National register, sounds a bit like a portal, I suppose. New rights to tenants, and again, right to have pets is one of them. And these are the ones that are probably more worrying. Right to make alterations to your home. Well, what alterations, who approves it, who pays for it, to what standard? And the right to request speedy repairs. On the face of it, doesn't sound that bad, I suppose, speedy repairs, but the question is, how speedy? Does that mean you have to hire somebody to come in? Does it mean you're paying call-out charges when you might not need to, etc.? So there's an issue with that, potentially. And finally, one of the next things, problem tenants. I think it's always been an issue if you're a buy-to-let landlord, but I think it's possibly going to be more of an issue with the cost of living crisis and other economic problems. If people lose their jobs, which some people are struggling with rising cost of living, energy bills, etc., then do they become problem tenants even if they weren't? I think that's an issue. If you have a very large property portfolio, it's worth saying, so tens or hundreds of houses, I think problem tenancy is less of an issue because it's spread across the entire portfolio, and it just becomes a cost of business. We know clients with very large property portfolios, and it's just a cost of doing business. All of those costs that we worry about as buy-to-let investors will basically, they just add it all up and share it across the portfolio, and it's a known cost and it's manageable. Where it's more of a factor is where you're a smaller landlord with 1, 2, 3 or 4 properties, where you kind of either have no issues and think that stories about problem tenants is oversold, or you will experience a problem, and of course it has a much bigger impact on you because it's your only property or one or only 2 or 3. Some couple of real life examples. We had a client who retired. She took her statutory cash from her pension in order to buy one investment property, which was against my advice, not because I don't think buy-to-let investment properties can be a good investment. It certainly can. It was just I felt it was all her eggs in one basket because it was a large part of her retirement income would be from this one property and one tenant. Again, for the first 2 or 3 years, no issues at all. Worked really well. Good tenant. Paid on time. No problems with property. Then I think there was a change in tenant. A new tenant came in, was not a good tenant. Didn't look after the property, didn't pay the rent, and then that client lost maybe a year's rent in trying to lost rent, getting the tenant out, legal costs, repairing the property on that period till it was relet. So that was and for her that was a whole year's income, which as one property was a big impact. Somebody else that I know is just finally thrown a towel in a buy-to-let portfolio. They had a number of buy-to-let properties, not massive, 3 or 4, and the final nail in the coffin of that was when he discovered a cannabis factory cannabis farm, in one of their properties, which was, you think would be bad enough, but also the tenants had taken out the internal walls, or some of the internal walls, in order to expand the growing area. So that's a huge damage to the property, huge cost to put right. And when the client went, or the contact went to their agent to get the details of the tenant, obviously legal action and possibly involve the police, to be told that, oh no, whilst the agent claims to have seen the ID of the client, of the tenant, they didn't actually take a copy. So the landlord had no proof of who the people were who were renting the property. Now there may be argument in both of those scenarios that with better vetting or better agents that you could have avoided the problems, but even then, I don't think that's a foolproof solution. Another one of my friends actually is an estate agent, so definitely well versed in the property market. Again, a couple of investment properties. Had a tenant, well, I've got a couple actually, a married couple, no issues with them, paid them the rent on time, really good couple. They then unfortunately split up, so the wife left, the husband didn't take it too well, and he starts drinking, doesn't go to work, loses his job, stops paying the rent, stops looking after property, property falls into disrepair. Again, huge expense, a year, maybe 18 months of rent cost, maybe more when you add up all the costs of getting the property back, evicting the tenant, bringing it up to standard and reletting it. So it's one of these things that people can be very lucky or very unlucky, but it's certainly a risk factor. And if you're an aging landlord, the question is whether it's worth the hassle. And falling house prices, you might think this is a new phenomenon, but it's not, and I'll come back to why it's not in a moment. But again, a lot of professional investors and buy-to-let investors will say, well, fine, I'm not bothered about house prices today because house prices always go up. To a large extent, they always have done over the longer term. But the question is, how long is the longer term? John Maynard Keynes famously said, in the long run, we're all dead. Now, if you're a professional landlord in your 40s and 50s, long term is not an issue. And you can probably weather some periods of falling house prices or static house prices. If you're in your 70s and 80s, that's less, less easier to weather in a sense. And again, house prices, whilst in the long term they have gone up, it can be very long periods where they don't go up. Well, so again, the average house price in the UK, this only goes up to 2021, so it doesn't show the most recent falls. But the two key bits of interest really are this period, 1988 to 1997, when I said, well, effectively house prices didn't move for 9 years. In reality, they did move. They fell by about 20%, peak to kind of trough, before recovering. So again, there's a 9-year period when you'd lost maybe 20% in capital value, and it took you 9 years to recover that money effectively. Again, that's the average. Some would have done better, some would have done worse, so it's a factor. But then, and again, banking crisis, so 2007 to 2014, again, similar fall, about 20%. Recovers a bit, but again, took 7 years in total to get back to where it was. Again, if you're in your 70s, 80s, do you want to wait 7 years or 9 years to get your money back? Houses can fall in price and could always be worse. And I would say that in this period, certainly even the banking crisis thing, it was relatively still benign for the house market in the sense that interest rates were lower. The recession, it was economically was tough, but there were still various good factors in favour of owning houses in the UK. These same factors might not apply at the moment. So that raises the question, is it time to cash out? And I think fundamentally that's a question for you as the investor to answer. I can only put together, I suppose, arguments for why you might want to consider this. But I think you kind of need to, at least consider that. So what do I think that you need to do or think about as a professional landlord or buy-to-let investor? Well, I think you need to acknowledge and understand the challenges that are affecting the market. Investors always tell me that buy-to-let is a business, and in any business you need to understand the marketplace. So I think that's fine. And the marketplace, I think, has changed significantly from the point it was in 1997 and throughout a long part of that period. And I don't see it necessarily changing for the better anytime soon. You need to assess the income and the capital position. Is it still profitable? Just a change in the mortgage interest relief situation alone, coupled with rising interest rates, can turn profitable properties into unprofitable properties almost overnight, really. And then having done that, you need to consider if now is the time to cash out. It won't be for everyone. Certainly for younger people, it might not be. Older people, it might be. It's not for me to tell people, as I say, where they should cash out. Really, it's just for me to raise the question. If you are looking at cashing out, then perhaps you need to consider alternative investments, and I'll run through those in a moment, and the different tax treatments generally they have. Also consider working with Ready Turn for independent financial planning and advice. We can help clients kind of manage that transition in the best way. So what are the alternative investment options for people? Firstly is individual savings accounts or ISAs. Most people have heard of those, investment or cash ISAs. I would say that in my experience, buy-to-let investors, which are very successful and build great buy-to-let investment portfolios, tend to overlook ISAs more often than not and don't take full advantage of those. You can pay up to £20,000 a year each into ISAs. So as a couple, married couple, cohabiting couple, that's £40,000 between you. And we've got clients with hundreds of thousands of pounds in ISAs built up over many years that are now entirely income tax and capital gains tax free, and can, in certain scenarios, also be inheritance tax free as well. You have to hold special assets in order to get them to be inheritance tax free, but it is possible. That way you can have a couple of benefits. A, the income, as I said, say if you're from ISAs, you can have the income tax free, but also what you can do is make your income tax position on your buy-to-let investment portfolio better, which is another thing. So they don't have to be a replacement. All of these things can be complementary to a buy-to-let investment portfolio. Secondly, you've got general investment accounts. Generally will hold the same kind of things as a ISA, and without quite the same tax efficiency as an ISA. So they're not income tax or capital gains tax free, but they do allow for capital gains tax planning by the buying and selling of investments within them in a way that is much harder with property portfolio. With a general investment account, you can sell one particular fund and buy another particular fund and realise a gain to use your annual capital gains tax allowances, which is much harder with property. The buying and selling costs of property make that much less viable. Investment bonds for wealthier clients, I would say. Investment bonds are another investment vehicle, and in essence, they shelter the gains, income, and capital on your investments from high rates of tax. So what clients will do, they'll hold those investment bonds whilst they are a high rate taxpayer, and effectively save tax by deferring a tax problem. And then we will look to access the money that's in investment bonds when their tax position is better. So normally we will do some planning to create a year or two when they have a lower income, and then can access that money. And that's incredibly powerful. You can also take withdrawals from investment bonds up to 5% a year for 20 years, and those withdrawals are effectively tax-free, or more technically tax-deferred, I suppose. You can also transfer ownership of the bond or parts of the bond to, say, children once they're over 18, and they can encash it. So you can use it for things like university fees planning and stuff like that. So there's a lot of tax planning involved. Pensions, I mentioned that ISAs were overlooked by buy-to-let investors. Pensions as well tend to be overlooked. Pensions have huge tax advantages that people overlook. Firstly, on contributions, which are limited or restricted by earnings, unless it's by way of an employer, generate income tax relief. So you get a reduction in your tax bill, or you get more money added to your pension on the contributions. The money in a pension is generally free of income tax and capital gains tax, and also inheritance tax as well, generally. And then when you come to take the pension benefits, obviously restrictions, it's a pension, you can't take it early, as it were, or too early. You can have 25% of the pension funds tax-free. The balance is taxable as income, so it's not completely free lunch, but it almost is. But also the value of that pension can pass to family free of inheritance tax, and then often free of other taxes as well. So it's incredibly great tax planning vehicle that people should take more advantage of. And finally, discounted gift schemes and other trusts. I'll focus primarily on discounted gift schemes. These are a special type of trust that allow you to gift capital to beneficiaries, normally children, but could be somebody else as well, and yet retain regular withdrawals, effectively income from that. And the advantages of that are you can gift the capital for inheritance tax purposes with an immediate inheritance tax saving and a further potential inheritance tax saving after 7 years, and yet retain an income. So if you've built up a large buy-to-let investment portfolio, but you've got an inheritance tax problem, so you're going to lose 40% of it on death, what you could do is you could look to encash that portfolio, and you've probably got capital gains tax, so you have to take that into account, but then use the net money to fund a discount gift scheme, which would be for the future benefit of your children. They don't get the money till you're not here, but you would have a regular withdrawal, so you can use that to replace the rent. And certainly for older clients, that can be incredibly valuable versus doing nothing and giving 40% to the tax man when you're no longer with us. It's a quick comparison of the alternatives. I won't bore you with it because I've covered a lot of it anyway, but it's available for you on the slides that we will send later after this presentation. One of the things that I've not particularly covered, but is liquidity, which is a big factor. So one of the issues with buy-to-let portfolios is that not very liquid. you've got the capital, but and a lot of clients will say to me, I've got this capital, but can't actually use it, Scott. So that's the problem. As I explained to clients, you can't take the door off its hinges of your rental property and use that door to pay for your shopping at Tesco's. Whereas if you have the other types of investments, with the exception of discounted gift scheme, you generally can take capital withdrawals. So you can take money out of your ISA or your general investment account or investment bonds or even your pensions to minimum wages and use that for shopping. So you can spend, of those investments, you can spend the income and the capital. Where buy-to-let investment portfolio, it's harder to do that because you've got to sell a house and that isn't quick. So whilst the other assets, you generally could get the money within a couple of weeks, maybe quicker sometimes. With property, it's generally harder to do that. And generally, you've got to sell the whole property. You can't just sell part of it, obviously. Of course, taxation varies based on personal circumstances, and it's vital to consult with an accountant or financial advisor for personal advice. So how can Rowley Turton help? Great question. Firstly, I think we can help you understand your overall financial planning picture. Generally, when we sit down with our clients who are in a fabulous financial place, they don't always understand that. Often you'll add up all their assets and investments and less any liabilities, and you normally find it's a very large number. And often clients will go, that's not right, Scott, I'm not worth that, because they've never actually sat down and ran through it. And you run through, well, the house is worth this, your investments are worth this, your car's worth that, it's cash savings, the investment properties are worth this, less any mortgages. So that's the right figure. And they're often amazed. So don't understand that. We can look at your income and expenditure, and we can also do future projections to bring it all together to see fundamentally, where you are. People who've not got enough and still need to keep working and building wealth. People who are just right, they're already there, they've got enough. And people got too much and should be perhaps enjoying it. So from that, we can calculate how much you need. And as I say, for often many people are already there. We can advise you on alternative options, ISAs, pensions, and more tax efficient investments in many regards. And we can work in conjunction with your other experts, accountants, solicitors, etc. Financial planning, certainly for buy-to-let investors, generally involves bringing in other experts. And finally, we can help you enjoy your wealth. A lot of our clients, particularly on the buy-to-let side, build up huge investment portfolios and don't actually necessarily enjoy that wealth. So part of our job is, I tell people all the time that I spend half my day nagging people to spend their money. Fundamentally, I think they should enjoy it. Enough book, as Martin mentioned earlier, there's a free book, Enough by Paul Armson, who I know very well. It explains the financial planning approach that we use with clients. People that have read it generally find it quite transformational, makes them think about their life and financial planning differently, so that they can enjoy their wealth, and that's fundamentally all it's really about. Fine, thank you very much, and time for questions and answers.
Well, Scott, thank you very much for all that. I hope everybody enjoyed that whistle-stop tour through buy-to-let investment. I hope that it hasn't been too much of a downer for people. So I know a lot of you will be thinking about the negative side, but there are also some positives, and there are also things you can do. So we've got some questions. We've got a couple of good questions here. If we don't have time to get to all of your questions, don't worry, we'll pick them up later and contact you directly. But Scott, a couple of questions, if I can shoot at you, please. Jamie asks, can you use profit from a private buy-to-let portfolio to invest in a private pension? Can you answer that, please?
Yes and no. If it's owned directly and you have no other earnings, then the simple answer is no. There is a de minimis that you can pay 3,600 gross into a pension regardless of earnings. So you could do that. But if your only income is from that buy-to-let property, then no, you can't. If you have a job or self-employment, small business or something like that, then what you can do is you can, in a sense, you can use the rental income to make pension contributions, but based on your earnings, if that makes sense. So you don't have to use your wages to make pension contributions. The taxman doesn't really care where the money comes from, but you can use money from other sources. So in that sense, you can. Or alternatively, if you own those properties via a limited company structure, so you don't own them directly, you own shares in your own limited company that owns the properties, then that limited company can make pension contributions. But if you own it directly and got no other earnings, then no, in simple terms. But again, we can sit down with people and run through how that works in practice.
Thanks, Scott. Yes, I was going to say to Jamie there that if you'd like to go through that, give us a ring, send us an email, and we'll take you through that very happily. Another question here, which is, Scott, I think Here, Jamie is thinking of the investment bonds. You were talking about alternative investments to buy-to-let properties. He says, are gains made from income bonds classed as income tax or capital gains tax?
Great question. If we assume that Jamie means investment bonds, then the gains made by the underlying investments that you don't withdraw, that tax is taken care of by the insurance company on your behalf, as it were. But then when you access gains yourself, by you cash in the bond or you take withdrawals above a certain level, then those gains are regarded as income tax or subject to income tax. However, depends on the bond, but if it's an onshore bond, then essentially the insurance company pays 20% tax in essence on your behalf. So if you're a basic rate taxpayer, there's no more tax to pay, depending on the amount you take out. But if you're a high rate taxpayer, there's normally 20%. But it's only 20% of the gain. Investment bonds are very good and very powerful. The tax treatment can be a bit tricky, and I would always advise clients to speak to an accountant or financial advisor before taking money out of an investment bond, because there are a couple of pitfalls where you can end up with an unnecessary tax charge just because what you've taken out and how you've taken it out. Very powerful, really great tax planning, and we use them a lot, but there are some pitfalls for the unwary.
Thank you, Scott, for answering that. That's really helpful. We've got a couple of more questions coming in. We'll get through as many as we can. There's a really good one here to put you on the spot, I think. Laura asks, if running for a limited company, and I add my child as a director, can I offset their school fees as a loss to the limited company to offset tax?
A great question. I'd assume that the child would have to be 18 to be a director. I don't know technically what age you have to be, but if the child is 18, then theoretically, yes. There's some issues. You've got the wholly exclusively for purposes of trade restriction for corporation tax relief, which might be an issue. But if the child is a genuine director, and I'll leave it up to people to interpret how many people are genuine directors, then yes, you can pay them a salary for being a director, and provided they're over 18, that shouldn't create an issue, and then they can use that salary to pay their own school fees. So that can be a good way. Revenues, a bit nervous, to put it mildly, on what they might see as income transference, but you know, it's certainly a thing to look at. If they're under 18, then I don't think it would work for parental settlement and other issues. But if they're over 18, it's fine. Equally, if they're over 18, you could possibly transfer them shares, albeit there may be capital gains tax issues with that, and they could receive dividends. And again, normally what I would do is saying, if you don't already have the limited company structure and are looking to set one up, speak to probably Mark Cook at Rhodes. I think it's probably the better person to speak to on this. But you can set up the limited company structure in a way that's kind of future-proof for this. And that's much easier to do before the company exists, as it were, and has no value. And then you can set up this for quite, I don't know, assertive or aggressive tax planning, depending on your position. But I think there's certainly options to consider there.
Thank you for that, Scott. I think, as Scott says, that's something where we bring in sort of colleagues on the accountancy side to help as well. Let's rattle for a couple of quick ones. Quick answers, please, if you can, Scott. Uche asks, can I pay into my private pension some money realised from the sale of my buy-to-let property? I think this is one you've covered already, though.
Yeah, effectively, again, the sale of the property is not income for the purposes of pension contribution purposes. But if you've got either the de minimis limit 3,600, or you've got other earnings that you can use, so you've got an allowance that you can use, then yes, you can. You can use the money, but not necessarily the gain, if that makes sense. Again, probably want to discuss it with ourselves and an accountant, just make sure that you fully understand the difference.
Thanks for that, Scott. And David asks, this is an interesting one here, one thing I don't think we've considered so far. It says the property investment landscape has been changing of late, with the introduction of buying shares in property or crowdfunding to invest in property or multiple properties. So crowdfunding, multiple ownership, is this something you've considered for clients?
Not specifically. There's always been property funds, certainly in the time that I've been in. So you've always been, now to be fair, they're primarily on the commercial property side rather than the residential side. I certainly think there's an argument for, I'm not sure on a specific structure of crowdfunding and that, and I'd be a bit cautious on the structure. We tend to prefer to use traditional established things where the risk is less and the ownership is more clear. I would want to look into that very carefully. I suppose the principle of having a more diversified portfolio makes sense. The issue is, how's the ownership structure? How do you get in and get out, and what the charges are? I'd be a bit cautious, but the principle is sound.
Thank you, Scott. I think I have to make this the last one, but David asks, I think it's an easy one for you, Scott, here, so an easy softball one to finish on. Can you easily transfer property ownership between spouses to take advantage of differing tax bands?
Oh, I think easy question. I think the general rule is yes, once. If you try to do it repeatedly, you're going to have issues because the revenue don't like you transferring for income tax reasons. You generally do it once, going back and forth would be problematic. And if an assumed spouse means you're married, if you're not married, different issues. Also, as well, if there's a mortgage on the property, you can potentially have a stamp duty issue. So again, you would need to take advice, but in principle, you can do it, just I wouldn't do it too often.
Thank you, Scott. Well, look, there are questions still coming in. Laura has just put another question in. Laura and some other people. Sorry we haven't got time for those this evening, but please would you drop me an email? My name's Martin at rowleydurton.com, and Scott and I will answer your question. Be very happy to. And on that note, I'd just like to say thank you very much all for joining us. And just to reiterate, if you have any questions or this seminar has raised thoughts in your mind that you might like to explore a little bit further, give us an email, come in, sit down, have a coffee with us over the boardroom table. There's no commitment. We can have a chat and see where we go from there. We're always very happy to meet new people. So we will be emailing you anyway with a copy of this presentation. We hope you find that interesting. Email us any more queries or get in touch if you'd like to have a chat. And the one other thing which we wanted to mention was the book called Enough, which is about a long-term approach to financial planning for your lifetime, getting the most out of life, is something which you give to clients and is often very useful. So if you'd like a copy of that book, a bit of light reading, drop me an email, martin@rowleysturton.com, and I'll be happy to put a copy in a post to you. So I think that's everything for this evening. Thank you very much for attending. We'll be doing another one of these seminars in a couple of months, I expect, perhaps sooner. We expect to be a regular series, so hopefully you'll find those of interest as well. Thank you very much, and good night.